Hey guys, I'm back. Sorry for the long wait. So I know my last video I dropped end of November, and I was expecting to be able to drop a video every week. However, life happens, things come up, and I wasn't able to be as consistent as I wanted to be. But I really do want to continue our Mind Over Pips series. I just am not going to make any promises on how often I post. Also, in other news, I am currently pregnant. I'm 8 months pregnant. And so that's kind of where the delay came in me making my videos because I've been super sick. I had to go to the hospital a couple times. Yeah, it's just been a lot going. But I'm feeling much better. And while I have the energy before baby gets here, I want to try to record as many videos as I can so I can kind of post them more consistently for you guys. But I am still heavily focusing on the trading mindset portion of things. I'm not currently personally trading too heavily, so it doesn't make sense for me to share my charts, but I could always talk about trading mindset. So that's what our focus is going to be on. So this next video, this current one, we're going to talk about different confirmation biases that you can have with your trading. We're going to kind of dive into the detail of the definition of a confirmation bias and the different types that you might experience as a trader. I think this is going to be really helpful to find, some repetitive issues or mistakes you might be making as a trader, but you're completely unaware that is due to a certain bias that you have. So I'm really excited to dive into this. And I definitely still want to cover our trading journal. I'm actually working on a ebook for you guys that's going to go really in detail on how to create a trading journal. So that way you're able to keep track of your trades throughout the year. And it's really easy to do, but sometimes you need some help to figure out what steps to take. So that should be coming out soon. I have been working super hard on that. So that should be coming out soon. So be on the lookout. But without further ado, I know this feels kind of rushed, but I'm just trying to get as much content done as I can. I really want to be consistent and provide value to you guys. So we're going to go ahead and get into the mind over pips. And I will see you guys next time with our next topic. Let's go ahead and get started. Hello, everyone, and welcome to Mind Over Pips, Trading with Confidence. I will be leading this video today. I am Pivot's Queen, aka Courtney, and we will be going over different confirmation biases. Now, do be warned, I do have a sore throat. I just had some tea, but I'm powering through because I really want to get this content done for you guys. As I said in the intro, I'm currently pregnant, almost 9 months pregnant, and so I'm trying to get done as much content as I can before a baby gets here, so that way you guys have resources to lean back on before I get into the full swing of things. Again, I can't say how consistently these videos will drop, but they will be jam-packed full of information, and definitely will be rewatchable for you to come back to as needed. So let's go ahead and get started. Last time on Mind Over Pips, we went over the importance of developing a trading mindset. So the fear of losing money and making mistakes is one of the toughest challenges every trader faces. Unfortunately, taking risks that may lead to losses is an inherent part of trading. Losing is just a part of the game over here. Loss aversion refers to the anxiety of missing out on potential gains. To overcome this, traders should treat their trading activities as they would a business. We are not gambling. We are not taking high-risk trades. We are operating within a business mindset. And a highly effective strategy to focus on data and facts. This is going to prevent emotions from swaying your trading decisions, right? Beginner traders should consider adopting this mindset before embarking on their first trades. So before you even hop into the market, make sure you already have that mindset of focusing on any data and proven facts, right? You want to actually already come in with a trading strategy that you've practiced in a demo, that you feel like you've somewhat mastered, and you know what steps you're going to take when certain things happen in the market. So that way you're not trading off of your emotions. Establishing a routine is another key to fostering a positive trading mentality. This routine may include a structured approach to starting the day. For example, a trader could begin by catching up on market data released overnight and then review their portfolio and risk management strategies. Enhancing trading performance is more about how you learn rather than what you learn. This underscores the importance of having a routine and is essential for understanding and applying effective trading techniques. We're going to talk about cognitive biases. We're going to explain what a cognitive bias is and different types that might affect you in your trading in the market. Now, trading fundamentally revolves around making decisions. Individuals actually already have an established belief system that influence their decision making. This phenomenon is a clear example of cognitive bias in action. So basically what a cognitive bias is, just in simple terms, is we were all raised differently. We all have different backgrounds. We all have different life experiences. And those experiences in life help dictate our decisions, what type of decisions we make, how we make those decisions. And that is what is considered cognitive bias. So my decision in a certain situation might be different from yours because we have different life experiences. So that's just kind of a simple way of putting it. I do have my background. I have my master's in psychology. So this might get a little technical, but I'm going to try to break down everything so it makes the most sense in layman terms. But let's kind of get into the definition I have here. So cognitive biases are systematic patterns of deviation from norm or rationality in judgment. They occur when the brain processes information in a way that leads to errors in thinking, decision-making, or perception. These biases can affect how we interpret information, remember past events, and make choices. Trading biases are the subconscious barriers that can cloud a trader's judgment, leading to irrational decisions and potential costly mistakes. These biases often stem from emotional responses, preconceived notions, or cognitive shortcuts that our brains use to process information quickly. A common trading bias is confirmation bias. We're going to really dive into that, where traders tend to favor information that confirms their existing beliefs and ignore data that contradicts them. This can lead to a skewed perception of market conditions and poor decision making. To overcome trading biases, traders must first be aware of their presence. Self-reflection and keeping a trading journal can help identify patterns in behaviors and thought processes. Additionally, implementing a structured trading plan with a predefined rules and criteria can help mitigate the influence of emotions. So it's really, really important that you have a trading plan, you have trading rules, and you keep a trading journal to know when you are actually following your rules and to know when you're not following your rules, and you'll start to see a pattern. Again, I am working on a trading journal ebook, so be on the lookout for that. That's really going to dive into that. But let's continue talking about cognitive biases. So can cognitive biases influence a trader's mindset? In short, yes. It can play an effect on your decision making. It can play an effect in your judgment. So what you see in the market, and you tend to look at things from an irrational standpoint, and you are solely basing things on your emotions rather than all the data that is readily available. So that's how biases can influence your trader's mindset. So I have a list here of common trading biases. Now, this is not all of the biases because there is a lot of them out there. However, these are the most common ones, and even in this presentation or this video today, I'm not going to go over each and every one of these, but I'm going to try to cover the ones that are the most common. And if you guys want me to dive more into biases or cover more biases, or if there's a bias that you see here and I didn't dive into in detail, just comment in the comment section below and I can always go back into it so I can dive more into detail about it. So let's go ahead and get through this list. So overconfidence bias, traders may overestimate their knowledge or predictions, leading them to take excessive risk or ignoring warning signs. Confirmation bias, traders may seek out information that confirms their existing beliefs while disregarding evidence that contradicts them, which can reinforce poor decision making. Loss aversion, this is the fear of losing money, and this can lead traders to hold on to losing positions for too long, hoping the market will turn in their favor rather than just cutting their losses when they see it's turning into a losing trade. Anchoring, traders may fixate on a particular price point or past performance, which can skew their judgment about future potential and lead to poor entry and exit points. Herd behavior, traders may follow the crowd and make decisions based on the actions of others rather than their own analysis, leading to market bubbles or crashes. Recency bias, traders may give an undue weight to recent events and trends, believing they are indicative of future performance, which can result in hasty decisions. And then sunken cost fallacy, traders may continue to invest in a losing trade because of the money or time already spent rather than evaluating the current situation objectively. So being aware of these biases, traders can work towards mitigating their effects, fostering a more rational approach to trading decisions. So all of these can affect your trading. They have some type of bias where you're not thinking completely straight and you're focusing on, one aspect or another that is affecting your decision making. So conquering trading biases. The initial step or the first step to overcoming trading biases is to thoroughly understand them in order to identify when they arise. Traders can adopt several practices to kind of prevent these from happening, including adhering to disciplined trading plan, relying on objective data, and reflecting on previous trades. By acknowledging and tackling these biases, traders can enhance their performance and make more rational choices. So you really want to make sure you take the time not only to journal your trades and document what trades you're entering, but taking time to look back on your trades and see how things played out and see what your thought process was. That's what's going to help you identify what biases you might be facing, and that's going to help you overcome them. So let's dive a little deeper into these biases. First, we have confirmation bias. A confirmation bias is a cognitive bias that favors information that confirms your previously existing beliefs or biases. Right? So confirmation bias not only affects our information gathering, but it also shapes our interpretation and recall of that information. So indicators of confirmation bias include actively seeking out information that confirms your belief while ignoring or diminishing opposing views, focusing on evidence that supports existing beliefs instead of considering all of the available information, retaining facts that align with your perspective while overlooking or forgetting those that contradict them, and experiencing strong emotional reaction, whether positive or negative, to information that aligns with their views while remaining largely indifferent to information that does not. Right? So imagine you're about to take a trade. You tend to seek out information that only backs your thesis. This can pose a significant issue for traders. When you focus solely on data that supports your directional bias and fail to acknowledge the potential downsides of the trade, you may become overly optimistic and increase your lot size excessively. This mindset leaves you unprepared mentally for when the trade takes an unfavorable turn. So if you are looking for a sell on Euro USD, you will only look at the information that supports your idea that Euro USD is selling. If there's any information on the chart that you see that could, say that, it could buy instead of sell, you tend to ignore that information because it does not fall in line with what you were thinking. So that's essentially what confirmation bias is. And a lot of us tend to struggle with this one. So make sure you're aware if confirmation bias is standing in your way. Overconfidence bias. This is a huge one. So, overconfidence bias is a cognitive disorder that leads to individuals to overrate their skills and knowledge, resulting in excessive trading, higher expenses, or neglecting crucial information and feedback. This bias can lead to investors to make unwise financial decisions. While confidence is important in trading, it should be moderate. It shouldn't be extremely high, but you also can't trade with really low confidence either. It should be somewhere right in the middle. Overconfidence often creeps in after a successful trading day. For instance, imagine you just achieved a fantastic 5% gain and you're feeling on top of the world. Then a thought crosses your mind suggesting that with a slightly larger lot size, you could have achieved a 10% gain. You carry this mindset into your next trade. Instead of adhering to your risk management guidelines, you end up risking far more than you should on that second trade. Unfortunately, trade number 2 hits stop loss, resulting in a loss in half or even all of the profits that you just made, right? So a lot of us have been there where we've had a winning trade or even a winning streak and we feel like we are unstoppable. Then we try to up that lot size and then we start losing all of that profit we just gained by following our trading plan and following our risk management rules, right? And so that's why risk management is in place to prevent things like this. So let's dive a little bit more into understanding overconfidence bias because it can lead to other types of biases. So most individuals believe they possess qualities that set them apart, such as being more intelligent, more honest, or having a brighter future than the average person. This overconfidence is a common challenge in financial decision making. It also creates significant vulnerabilities since it contributes to other biases, including hindsight bias, attribution bias, and self-serving bias. An inflated sense of trust in our ideas and abilities can obscure our awareness to how susceptible we are to making mistakes and misconceptions. Additionally, it leads to us to downplay or overlook our shortcomings, often shifting the blame onto external factors or onto others. Risk of overconfidence bias in trading include excessive trading. So overconfident investors may trade more frequently than required, resulting to increased transition costs or perhaps worse investment returns, right? So if you're trading too much, you could face having way too many trades going at once, or you could risk, potentially losing more profit than you need to because you're just trading so often. You also have underestimating risk. So overconfidence can lead traders to underestimating dangers connected with a particular trade, thereby exposing themselves to needless financial losses, and then ignoring contradictory evidence. So overconfident traders may minimize or disregard information or data that contradicts their initial choice, causing them to hold positions in underperforming assets and succumb to confirmation bias, right? So overconfidence bias can lead to confirmation bias. And then types of overconfidence bias. So there's subcategories to this. So just to name a few, the illusion of control. This occurs when individuals believe they have greater influence over outcomes than they actually do. It often leads to an inflated perception of one's ability to predict or affect market movements in investing. Closely related is the illusion of knowledge, which refers to the belief that we possess more information than we truly do, and that acquiring more information will improve our accuracy. So we kind of have this belief like the more we know, the better the results will be, and that's not the case. Optimism bias is the bias that manifests when a person exaggerates the likelihood of positive events while downplaying the chances of negative ones. An example of optimism bias is overestimating, where individuals tend to think their skills or performance is more favorable um, compared to others or objective standards. So basically, you feel like you have more of a chance than winning than someone else, and you're just really more optimistic than you need to be. And then miscalibration, this refers to the tendency to be overly confident in one's predictions, leading to a disconnect between perceived and actual abilities. Such miscalibration can cause traders to inflate their market predictions. So this is kind of like you think you're always right all the time. And that's not the case, because we know as traders, we all face losses. Even the best traders experience loss. But if you have that belief that you're just so much better than everyone else, when you do lose, you feel like, oh, that's not right, because I have all these skills and abilities. Next, we have FOMO, or fear of missing out. This is a psychological bias that may occur to, a lot of new traders, and it often manifests as anxiety or urgency when they observe observe that others are profiting from trades or investments. This fear can significantly impact trading decisions in various ways. It frequently drives traders to make impulsive choices, prompting them to purchase stocks or assets merely because they see others doing so, or because they see that prices are rapidly increasing or decreasing. Such impulsivity often results in entering trades at unfavorable prices. Moreover, when traders act on FOMO, they tend to rely on emotions rather than following a well-structured strategy. This emotional decision-making could cloud their judgment, leading to poor choices and increased risk of losses. In the rush to capitalize on perceived opportunities, new traders might also neglect essential analysis and research, often disregarding their trading plans or market indicators. This oversight can result in unwise investments spurred on solely by fear. Additionally, influence of peers and social dynamics can amplify FOMO. So when traders see friends, colleagues, or online communities making profits, it can create a social pressure that leads them to act against their better judgment, driven by the desire to conform or avoid that feeling of being left behind. Following impulsive trades fueled by FOMO, traders can or traders may experience regret if the trades do not yield the expected results. This can, or this regret that you have, like if you're following a trade based on FOMO and then, ends up hitting stop loss instead of you making a profit, this can foster a cycle of chasing the next opportunity, further intensifying your FOMO. So understanding this phenomenon is crucial, especially for new traders, as recognizing its influence can help them become more aware of their trading behavior and decision-making processes. So FOMO is a really big one. We always feel like we're missing out when the market's moving, and you constantly have to tell yourself that the market's always going to be moving, so you don't have to feel like you're missing out just because people are making a profit and you haven't entered a trade yet. You still want to take your time to analyze the market, analyze the data, and make decisions based on what you believe is correct instead of following the crowd. Next, we have revenge trading. So, revenge trading is a harmful behavior that often occurs or often affects Forex traders, particularly those who are new to the market. This behavior typically arises after a trader faces a loss. Instead of taking the time to analyze the situation and modifying their strategy, the trader may experience a strong emotional impulse to quickly recover their lost funds. This can lead to impulsive trading decisions, where a trader may risk more than usual in hopes of recouping their losses. Several psychological biases can intensify this mindset. Overconfidence bias may cause traders to overestimate their ability to bounce back after a loss, prompting them to take on excessive risk without considering the potential fallout. Loss aversion can result in traders holding on to a losing position for too long, believing things can turn around, which frequently leads to an even larger loss. The sunken cost fallacy may contribute to a trader's to continue investing in a losing trade simply because they have already committed their time and resources, ignoring the fact that past decisions should not dictate future actions. Similarly, herd behavior can lead to traders to mimic the actions of others instead of relying on their own analysis, often resulting in poor outcomes. And then lastly, recency bias can cause traders to focus too much on the recent losses, leading them to make irrational decisions and attempt to compensate for perceived failures. Overall, revenge trading can create a cycle of losses and heightened stress, ultimately harming a trader's overall performance. It is crucial for new traders to recognize these psychological traps and strive to maintain a disciplined trading approach, prioritizing strategy and analysis over emotional reactions to losses. So now I've gone over a couple trading biases. Granted, I did not go over the whole array of lists. So again, if there's any trading biases that I have not covered and you want me to dive deeper into, make sure you comment down below and I will make sure to make a video about that to help you out. But let's kind of start talking about strategies to overcome these instead of focusing on, the mistakes we might be facing. So steering clear of emotional trading. It is not about eliminating your emotions, it's about understanding and maintaining them. To achieve this, a trader must establish a clear trading plan, develop a detailed strategy using fundamental research, technical analysis, or a combination of both. Document your trades into your trading journal to identify your strengths and weaknesses and avoid emotional trading and frequent strategy changes. You do not want to strategy hop, changing your strategy just because you feel like yours isn't working. Or, it's like, okay, I keep hitting stop loss and you try to just go from scratch and learn a completely new strategy. No. Keeping a trading journal can help you figure out, okay, what you might need to tweak here and there and change one little thing about your strategy instead of just throwing your strategy away completely. And I just want to say every strategy out there works. You just have to find the one that works best for you. Because anybody can see success with any type of strategy, right? You also want to make sure you assess your risk tolerance. So understanding your comfort level with risk, especially if you're new to trading, and tailor that to your approach. That's essential. And then recognize when to take a break. So feeling anxious or fatigued, you might want to take a break after you had consecutive losses to reflect and avoid mistakes or revenge trading. So we're going to dive deeper into more strategies that you can use to overcome a lot of these biases. But if you get nothing from this video, make sure that these 3 stick with you, that you make sure you have a clear trading plan, that you're documenting your trades in a trading journal. You know how much you're comfortable with risking, and that's going to differ person by person, again, because we do have cognitive biases built in. So what I'm comfortable with risking might be different from what you're comfortable with risking, because we just have different life experiences and paths in life. So you might be okay with risking 5%, where I might be okay with risking 1%. It doesn't make it right or wrong. You just have to know what you're comfortable with. And then you need to know when to take a break. And that just might be a 10-minute break. It might just so you can take a walk, get away from the computer, go outside, get some fresh air, put your feet on some grass, come back and readjust. Or you might have to take a longer break. You might have to take a week break or even a month break just to kind of reset your mind. But taking a break does not mean that you've quit trading. It just means you're taking a second to regroup That way you could come back refreshed and more willing to following your trading plan. So however long of a break you need, it does not matter as long as you always come back and keep building on your skill set. All right, so strategies to conquering common trading biases. So it's going to be a little list of different strategies, but all of these strategies will be helpful. So whichever one stick out to you, make sure you try it and it might help you out. So setting clear criteria. So you want to establish criteria for decision making that encompasses both bullish and bearish factors to help you evaluate trades objectively. So even if you're looking for a sell on Euro USD, you also want to look for the possibility of a buy, right? You want to be open-minded whenever you're analyzing the market. Practice mindful awareness. So recognize your thought patterns and be aware when seeking information that confirms your belief, allowing you to conquer these tendencies. So, make sure you're listening to those inner thoughts as you're analyzing the market, and it's not just leaning more towards one side, and you're actually taking in all the data that is readily available. Seek contradictory information. Pursue data and opinions that challenge your thesis, such as a bearish analysis or failure scenarios for your trades. So just make sure you keep in mind there's a chance that the trade could go against you and you could possibly hit stop loss. How are you going to prepare for that? You also want to make sure you develop a trading journal. So keep a detailed record of your trades, including rationale behind decisions, and reviewing regularly to identify bias patterns and learn from mistakes. Engage in peer discussions. So discuss trading ideas with peers or mentors to gain insight and challenge assumptions. So even if you just have a trading buddy, it could just be one person or two people, very small group, where you just discuss your trading ideas because someone else might have a different opinion. So you want to be open to that. Implement a risk management strategy. You want to use a stop loss orders and position sizing techniques to manage your risk, reducing emotional attachments to the trades. Take breaks and reflect. If you are overly attached to a viewpoint, take a break from trading to gain a clarity and reduce bias. Educate yourself continually. So stay informed with market conditions and strategies to make more informed decisions without relying on preconceived notions. Diversify your sources. Get market information from diverse analysis, news outlets, and communities to balance your view. Stick to a trading plan. So develop and adhere to a comprehensive trading plan to conquer emotional decision making with a structured approach. Seek out others' point of views. So leverage your trading community to diverse perspectives and second opinions. Again, even if it's just a trading buddy, or if you have a mentor, someone that introduced you to trading that you can reach back out to get a second opinion, always want to seek other point of views. Set realistic expectations. So understand market unpredictability and prepare for both gains and losses. Adapt a systematic decision-making system, right? So use an organized approach to incorporating quantitative and qualitative data to minimize cognitive biases. So you just want to make sure you have a step-by-step approach to how you enter in the market, and you keep that list with you at all times. So that way, every time you enter the market, you're following the same steps. Limit exposure to social media. So focus on your analysis and research instead of getting caught up in the social media hype. Social media is just not the best place to be as a Forex trader or trader in general, because you'll see someone be like, oh, I've made all this money on a gold sale, but you don't have all of the clues or details included with that gold sale. And you don't want to get into that following the crowd mentality or herd mentality. We're just hopping into a gold sale because you saw someone make $100,000 on gold, right? And sometimes it's not the most realistic especially when setting expectations. So you want to limit your exposure to social media, especially when you're new, until you're like establishing yourself as a trader and you have that trading plan down to a T. Reflect on past trades. So, using a trading journal to identify FOMO related behavior patterns and learn from them, right? Not just FOMO, but any type of behavior patterns. You can notice them just by documenting your trades and then reflect on them. Focus on process over outcome. So, value the trading process over immediate results, improving your skills rather than fixating on profits. So, do not let the fact that you had a 5% gain week determine that, oh, I'm doing good, right? You want to focus more on the process of getting there and how often you're actually following your trading plan versus the profits that you gain for the week, right? You could have a net negative week, right? And have no gains for the week. But if you followed your trading plan to the T, then you have had a successful trading week. Use visualization techniques. So visualize sticking to your plan and making rational decisions to reinforce positive behaviors. Seek support. So join trading communities or find a mentor for guidance and accountability. Establish clear guidelines. So you want to outline perceived entry and exit points along with risk management strategies in your trading plan to minimize impulsive decisions. Limit position sizes. So maintain smaller positions to lessen the emotional toll and reduction of revenge trading temptations, right? So if you're using smaller lot sizes, you're less likely to revenge trade because you're not putting a lot at risk or you're not losing a lot in a trade. And then finally, view losses as a learning experience. So refrain from losses or reframe losses as a learning opportunity to enhance your future decision making. So if you do lose, don't look at it as a loss or a negative. Look at it as something that you can learn from and you can gain from. Ultimately, overcoming trading biases requires discipline, continued education, and a commitment to objective analysis. By cultivating these habits, traders can enhance their decision-making process and increase their chances of success in a dynamic trading world. So I hope that these strategies are helpful to you. If you had any of these trading biases affect your trading, share it in the comment below. So, other traders can see like, hey, they were struggling with that too. Or, hey, I struggle with FOMO, and you might find a support system for that. But that's going to be the end of our video for today. I hope you guys have enjoyed. Make sure you like, comment, and subscribe. That really helps me out. I really want to build this channel and make sure I'm passing on information to traders so they can really excel in this trading world. So I hope you guys have enjoyed, and I will see you next time.